Hi, this is Hutch with BankingTruths.com, and today we're going to look at what happens when your clients can't fully fund an IUL policy as you had originally intended for them to do. So even though it says X client on the top left, that actually stands for example client. If you don't want your clients to become X clients, it's good that they fully understand the range of flexibility inherent in IUL. And this is actually part 2 of a series before we looked at what happens when they pay their premiums late and how that affects policy performance long term. What we're showing here is if they can't get anywhere near the projected funding amount and how that affects ongoing performance. So let's jump in here and look at the non-guaranteed cumulative premiums. That's what these colorful lines are representing. The blue is optimal, and you can see they're all overlapping down here. So in the first 2 years, this particular client pays $60,000 a year for 2 years. Cumulative funding of 120. This is the maximum allowable non-MEC premium for optimal growth and income in the future. Now, the blue line is the optimal funding scenario that you can see they get in 5 premiums of $60,000 in 5 years. However, they fall far short of that with the green scenario and the orange scenario. And you can see that the orange scenario is funding substantially lighter premiums. It's actually $5,000 a year for a number of years, and they pay much longer than the green scenario, who pays $10,000 a year for a number of years. And let's just look exactly at what's happening here in the simplified spreadsheet view. So again, exact same policy across the board, starting with 1.295 of death benefit, planned premium of 60. And you can see here that the 60,000s are going in for 5 years, totally optimal. In the green scenario, we see 60,000 for 2 years and then tens for 5 more years, filling it up after, or filling up as much as they can after 7. What happens after that is we drop the death benefit substantially, as you can see, as well as with the orange scenario where we pay $60,000 a year for 2 years and then $5,000 a year until year 15, at which, and we drop the death benefit in all of these scenarios, in the 2 light funded scenarios after the 7th year, because, well, let's face it, clients start this not as much for protection, but for long-term performance. So if we want the performance of this light funded scenario to look good, we need to drop the death benefit to the lowest amount that the IRS will let us. There is the 7-pay test in the way, but after 7 years, we get a new 7-pay test and we can go ahead and squash the death benefit. So let's jump back into the visual part of our software to see the effects on, first, surrender value. Actually, let's look at the death benefit first so you guys can see and visualize what happens with the death benefit. So for these first 7 years, the blue is growing more because we're using an option 2 death benefit where the death benefit increases by the growth of the cash value. And obviously when more premiums going in, therefore the death benefit and the cash value are growing in tandem. But when we light fund these, it's hard to see the green behind the orange here, but the 2 are in tandem. The death benefit stays relatively flat after that 60, and then you can see after the 7th year, we just squash the death benefit to the lowest level possible. And since more money went into the green scenario because they were paying $10,000, the death benefit is going to be higher. You can see the death benefit starts to go down again here at age between 64 and 65, and that's because we start taking income, and we're going to visit that in just a moment. But if we now look at the effect of surrender value, obviously it'd be better to get more money in sooner to this policy and let it flourish. You'd have a lot more cash value, just for paying 5 premiums of $60,000 a year. Even at the average AG 49 rate, we're looking at $716,000 of cash value. Now, substantially less for the green scenario and the orange scenario, but remember, in this scenario, we only got in 170 of premium, and it took us longer to get it in there. In the orange scenario, we got $185,000 of premium, and it took us even longer to get that money in there. But still not a bad pile of cash for something that had the risk profile of something more like CDs, savings accounts, or the like. if we stretch this out to see the effect on income here, let's go out to life expectancy. We can see that what happens to the surrender value is, obviously the blue is going to be higher along the way. There's more money in there, but the orange and green are holding strong in tandem. If we look at cumulative income, and let's just back it up to the first year so we can see how much the level income is. It's obviously a lot less than the max funded scenario, but remember, we put in substantially less premium and it took longer to get it in there. But still, putting in $170,000, $185,000 to take 30 to 31, almost 32,000 of tax exempt income for 20 years, and to total 612,000, 638,000 of tax exempt income over the course of 20 years is not too shabby, especially considering that's not all that happens here. So clients often forget that this is a life insurance policy since they're using it for income. And if we go back to the death benefit amount, even though the death benefit shrunk quite a bit, there's still over 6 figures of tax-free death benefit left behind for heirs. And most of our clients are not going to leave the undertaker with the bill. Sometimes they're even going on these infomercials and buying burial policies anyway. So this essentially acts as their burial policy, clean up any lingering affairs from any illnesses that they may have had, hospital bills and whatnot. So almost the full, well, not the full amount, but close to 2/3 of the premium, somewhere thereabouts, is actually left behind in death benefit. And they got to enjoy all this tax exempt income plus some amount of death benefit the whole way. So what I want you to take away from this is, even though clients look at the bill of their insurance policy as this rigid thing that has to be met, although that may be optimal for them, it's not as rigid as they think. And so showing them that there are these escape hatches, there are ways to bow out of what was originally planned for them, and how they can still produce a favorable result, not only during their lifetime, but also at death, can often help them wrap their head around why they want to use index universal life as an asset class.